Hi, welcome to Manifestations. My name is Brian, and today we are going to talk about investing in shares, and that is the pros and cons of investing in shares. Investing in shares is one of the most common sought after information. How do I get started? How do I own a piece of a company? How do I start getting the dividends? But most of the time, there are information that we don't get, especially what are the advantages and the disadvantages. And in today's video, I'm going to break that down to you. And if it is your first time here, there's a reason why you need to subscribe, because in the coming few videos, I'll be addressing the pros and cons of investing in different places, whether it's treasury bonds, treasury bills. And if that is information that you could be interested in, press that subscribe button right now, and please remember to share this as well. So straight to the topic of the day, what are some of the pros and cons of investing in the shares or in the stock market? And to start us off, I wish to start with the good news first. What are some of the pros of investing in the shares? Shares are one of the best places for you to get capital gains. Capital gains can also be looked at as appreciation in value, whereby you bought something at this value and now the value has shot somewhere up there. So that is one of the ways that has made so many people very wealthy. By the time Warren Buffett was buying into several of those companies that he's invested in, the value at which he got them was very little compared to what the value is right now. If you bought a company's shares when they were trading at about 10 shillings per share, and then over the years, the value has grown to 100 shillings per share. So it means that if I had invested 1,000,000 shillings into the shares or 100,000 into the shares at 10 bob per share, and then the value has multiplied and gone to 100 bob per share, that is like a 10 times increase, then it means my 1 million has grown to 10 million in value. So that is what is referred to as capital gains, and this one you get it when you invest in the shares. The second good thing about investing in shares is earning of dividends. Most of the companies do pay very good dividends, some of which will give you a better return when your money is invested in the shares compared to the money being invested in other different places. So the shares will give you an opportunity to get a better return. Sometimes some of these companies could pay you dividends up to 15%, 20%, depends on how that company performed. Remember, you get to earn dividends based on the gains or the profit that the company made. So you share in the profits with the rest of the company owners. The third advantage that you get when you invest in shares is passive income. This is one of those things that make me love investing in shares, because you don't go to work, you're not part of the directors, you don't report to work from Monday to Friday, you don't have to think about the profits, what is going to make it better, but you still get to have an income. So by the end of the year, when the profits are being shared, you get a portion of the same. So this builds a better way for you to earn a passive income and to build wealth that pays you without having you necessarily part of the process of making that money. So my job would be to look for more money and buy more shares so that I may increase my passive income capabilities. There is also another benefit or advantage that comes with investing in shares. Shares help you to remain disciplined. Give me a moment, let me explain that. When you invest your money into shares, you cannot be able to access that money anyhowly. If, for example, I've invested about 1,000,000 shillings in shares, I cannot go to the market and just say that I'm disposing of this 1 million worth of shares and I'll have the money in the next 5 minutes or 10 minutes. Because remember, when you go to the market, it all depends with the dynamics. It is me selling and there has to be a ready buyer who also wants to buy. So I have to exchange the shares with someone who wants to buy them. And there are some of the companies which will take you a long time for you to dispose of all those shares. And that is what I meant, that it helps you to develop a discipline that keeps you and the money that you've invested away. Some of the options that we invest with, you can access the money instantly. You can be able to withdraw at any given point that you want to. And that one means that any money that I save today, I can be able to use it tomorrow. But when it comes to shares, by the time that I want to access that money urgently, perhaps the markets will already be closed. I can't even access that money in the first place. Even if I wanted to sell them, I can't sell. I have to wait all the way to the next time the markets are going to open. If that was on a Friday, Friday evening, then I would have already saved my money. I wouldn't have wasted it over in the weekend because I have to wait until Monday for me to sell my shares. And by the time Monday comes, I don't really think that the emergency will still be an emergency anymore. So the shares will always give you a way to build your wealth slowly with time while helping you not to lose the money that you are putting or collecting together. And now let us jump to the second side of the story, which are the cons or the disadvantages of investing in the shares. These are some of the most important things that you need to know about before you put your money into the shares. And the first thing on that list is volatility. What do I mean by volatility? Volatility in the shares means that sometimes the prices could go up or go down without notice. You could sleep, the prices were looking good, and tomorrow wake up, the prices are looking terrible. So things change abruptly. You can really never tell whether things are going to go positive or negative, even if you did all the analysis right. One event in the market or one event in the public or in the government, one announcement over here can actually change the whole situation, and prices could either shoot up or go down. Of course, if they go up, it is in your advantage. That is what we call capital gains. But again, the volatility in it does not mean that things will always go up. I remember one of the companies like Safaricom had a growth at a certain point. The prices went all the way to 40s per share. And then so many people bought into it because it looked like something that was going higher and higher. And then whoosh, things came down. Prices came all the way down to 11 bob, to almost 10 shillings a share. And do you want to know what that means? If I bought in at 30 or I bought in at 40 and then I start seeing things going down, that means the value that I put in is already going down. So by the time it cuts by half, from 40 or from 30 to about 15, that means I've already lost 50% of the value of my money. So if I'd put in 100,000 as an investment, then I've already lost 50,000. But then I would like to encourage you that most of these losses are known as paper loss, because the moment that you decide to sell your shares, that is the point at which you will suffer loss. But as long as it's still on paper, the markets go down and they go up, so things again will peak, and you could get back to the point that you break even and even enjoy the capital gains. So remember, in shares, it is a long-term game. You do not get in today hoping that by next week, next month, end of the year, I will get my money back. By end of the year, by the time that you want to get your money back, you could be reading negatives. So that volatility, kama uko na pressure, hiyo wachana tu nayo mwanzo, wachana tu nayo, let it chill for a while. The second thing that you need to know about is the uncertainty of cash flow or uncertainty of returns. If you were keen last year, people who had invested in the KCB were so sure that they're going to get a dividend. But then what happened? The year ended and they announced, oh, we are not paying any dividend. So imagine you had your 1 million bob for the whole year. It stayed with them. It has to wait for another second year for you to be able to start earning something, if they will pay at that particular point. Because sometimes things could go silent. At times things go your way. Sometimes they might not go your way. So that kind of uncertainty, if this is the money that you're planning to grow to make sure that you get a cash flow out of it, please make sure that you think twice before you put it all in there. Because sometimes there is uncertainty of cash flow. That money could lie there for 3 years, for 4 years, without you getting capital gain or any form of return in dividends. So you better think about that carefully before you make that decision. But again, remember that this is a long-term game. It is not a short-term game. So whoever gets into this, put the money that you're willing to let be there for a long term. And this brings me to the third disadvantage, or something that you should consider before you put your money into the shares, and that is non-liquidity. I know that word sounds mouthful, but it is basically saying that you cannot be able to turn it into liquid cash or into cash at hand as quickly as you may want to. So it is also something that you need to remember and put into consideration. These should not be money that you expect to have in emergencies. They are not as liquid as other forms of investments. But once you already know that, then you will be channeling money that you expect to stay there for a long term, to allow it to grow, to allow it to accumulate and yield more and build your wealth, but not expecting that I'll walk there tomorrow when I have an emergency and collect all my money. It is not very liquid. And last but not least is a point that not so many people like hearing about, but investing in shares can sometimes turn into dead assets. And what do I mean by dead assets? I've already mentioned these when I talked about expecting passive income. There can also be a challenge when you're expecting to get returns from your money. There can get to a place whereby the value is not growing, so you're not getting capital gains, or you're not also getting dividends, so you're not getting cash flow, and your money could be chilling somewhere. A company goes stagnant or your company collapses. You're not getting profits year in, year out. You cannot sell or you cannot buy. This is something like if you owned KQ shares, you understand what I mean. Year in, year out, it is losses. The value went all the way down, and all of a sudden they're not even trading it anymore. So you have your money somewhere, but you cannot be able to withdraw. You cannot be able to sell because nobody is willing to buy in the first place. You are not getting any return from your money. This is the other aspect that you should be very careful when you're investing in the shares. Choose wisely the companies that you're going to put your money in. And again, you cannot be sure you're going to put your money in the right company. Sometimes giants fall. The bigger they are, the harder they fall. So things might be looking blissful, but that does not mean that it is a guarantee that when you invest your money, it is always going to be blissful. This is not to discourage anybody from investing in the shares, but this is to give you a point of consideration when you're looking at the pros and cons. Is it something that I want to get myself into? Is it something that I can manage? What extent of risk am I willing to take? Those are some of the things that you should be looking at when you're making your decision to invest in the shares. In the coming videos, you're going to look at the pros and cons of investing in the other classes of investments. Make sure that you're subscribed, make sure that you're following, and let me know in the comment section below any feedback or any topic that you'd like me to talk about in the upcoming videos. Thank you so much for watching. Please like, subscribe, and share these, and see you in the next video.